So we're up to exchanges of non-monetary assets. All right, so the company trades an old pickup truck for a new pickup truck. And these are both non-monetary assets. So I guess the first thing we really want to ask is, well, what are monetary assets? And so your monetary assets would be things like cash, accounts receivable, investments. These can be stated in terms of a dollar value. Your non-monetary assets that we're exchanging here, would be things like inventory, land, building, and equipment. Okay, so non-monetary assets. These are the things, and it'll mostly be like a land, buildings, and equipment that we'll be working with in the exercises. So when a company trades in their old pickup truck for a new one, the old one may have a $10,000 value, the new one is $30,000, and they may have to pay cash on the transaction to sort of make it work. So when it says non-monetary, there can be cash involved in these transactions, but what is being exchanged involves non-monetary assets. Okay, so there is some cash often involved. Okay, so let's see what we run into next here. In the old GAAP, what you're actually going to learn simplifies how it used to be done. What the new GAAP is based on now is whether the exchange has commercial substance or it lacks commercial substance. In the past it was, are these assets similar or dissimilar? So this is much simpler. Sure. Okay, so we have to figure out, the next thing is, what is commercial substance? So commercial substance, it's a transaction that means something. It changes the cash flows that the company will have. So if you exchange the truck for the machine or building for equipment, it's sort of a regular transaction that will change the future cash flows of the company. And so that's what, when it has commercial substance. When it lacks commercial substance, the future cash flows do not change. The best example of this is maybe you are trying to buy a car and you want a red one and the dealer only has a blue one, so they exchange the red one for the blue one with another dealer. It's not meant to be an end transaction, that exchange. It's to facilitate the sale to the customer. So it's not intended as an earnings transaction by either party. So there's all kinds of exchanges that could happen like that. Basically, in the book with the exercises, they'll tell you it either lacks commercial substance, in which case you account for it one way, or it has commercial substance, in which case you account for it another. Okay, so a few things that might be examples of lacking commercial substance. So the company owns some land with a book value of $1 million and a fair value of $5 million. The only way to recognize the $4 million in appreciation would be to sell the land or exchange it for another non-monetary asset for a legitimate business purpose. So if you did the land for the building and there would be a future change in the cash flows, the land would be recorded at the $5 million fair value. When we get into lacks commercial substance and you're simply exchanging similar pieces of land, it lacks commercial substance, the land would come on the books at that $1 million book value. We're not recognizing gains, well, in general, we're not recognizing the full amount of gains on that. And that's the basic difference between commercial substance and lacks commercial substance. It's how we treat the gains on the transactions. Okay, so that would be one example. What else I've got here? I've got a couple of other examples that you could take a look at. Oops, easy to look at, you can see them. Okay, so the gains and losses, when you're figuring the gains and losses on these transactions, it's going to be the difference between the fair value and the book value of the asset given up. And a lot of times it's easier to do these problems if you do that first. the amount of cash doesn't really have any impact on the gain or the loss. It's basically compare the old with the new, book value with the fair value. And with any non-monetary exchanges, sometimes the gain's going to be recognized immediately, that is if it has commercial substance, and other times it'll be deferred and sort of recognized over the life of the asset. Okay, so this stuff is really confusing when you start to get to do it. So I have a few things that may be helpful here. So if the transaction lacks commercial, or if it has commercial substance, it's just like a regular transaction. You recognize your gains and your losses. It's only when it lacks commercial substance, but then it depends on if there's cash received or paid. If there's no cash received, you're going to just defer the recognition of any gain, and it just reduces the amount of the asset that comes on the books. Okay? The key thing, this is what really gets you on this, is if the monetary consideration, in other words, the cash involved in the transaction is less than 25% of the fair value of the exchange, and you've got cash received or paid, then you have to do this calculation of the cash received or paid, the cash received or paid plus the fair market value of the asset received times the total gain, and that amount of a portion of the gain will be recognized. But if the monetary consideration is significant, in other words, more than 25% of the transaction, then it's treated as if it had commercial substance. And there's a couple of problems in there that'll nail you on that. You'll go through all the lacks commercial substance, and then you'll find that the cash is a big part of it, and you should have just done it regular. Okay, so just for what it's worth. Okay, so, they also use the term boot. Boot is just something in addition to, so the cash is referred to as boot. It's like, oh yes, she got this and to boot, like something additional. Why all the rules? Basically, they're trying to keep companies from just exchanging assets for the sole purpose of showing gains when there really is no commercial substance, no real significant good reason for the transaction. So that's basically it. Okay, so I think we'll just see if we can make some sense out of all this by doing a couple of examples.